If you are retiring with a $60,000 pension, you probably feel like you already won the game. That number sounds solid, comfortable, even safe. But there is a piece of the 2026 tax rules almost nobody explains to people in your position, and it can turn that same $60,000 pension into a $5,000 a year penalty on your Medicare premiums alone. Here's the reframe. A pension is not a check. It behaves more like a tax floor. Every dollar you saved in a 401k or an IRA sits on top of that floor, and the higher the floor sits, the closer you get to a set of tax cliffs that people without a pension never have to think about. And here's the part that catches people off guard. The person with the $100,000 pension often ends up with less real spending freedom than the person sitting at $60,000. Not because the math is unfair, but because of something called RMD stacking, a mechanism that can push your effective tax rate toward 40% once required withdrawals begin at age 73. We are going to walk through 3 tiers in this video: a $40,000 pension, a $60,000 pension, and a $100,000 pension, and look at what genuinely changes at each level once you add Social Security and retirement savings on top. I have sat across from retirees at every one of these levels, and the pattern repeats itself. The bigger the pension, the safer people assume they are, and the more blindsided they feel when the letter from Medicare shows up with a bigger bill attached. We will start at the $40,000 tier, because a law change in 2025 rewrote the Social Security math for a lot of public pension holders, and most of them still do not know it. Under the Social Security Fairness Act, signed into law in January 2025, 2 provisions called the Windfall Elimination Provision and the Government Pension Offset were repealed. If you spent your career in a job that did not pay into Social Security, teaching, policing, or other public service, those 2 rules used to shrink or wipe out any Social Security check you were owed. That's gone now. Someone with a $40,000 public pension, who was told to expect close to nothing from Social Security, might now see an extra $1,200 to $2,000 a month that was never part of the original plan. Picture it in real terms. An extra $1,500 a month is the difference between covering a rising grocery bill and a car payment without touching the pension at all, or watching both eat into savings you meant to leave alone. That's real money, and it's worth claiming correctly. That's genuinely good news. But sit with it for a second, because it changes the math in a way most people do not see coming. Financial planners sometimes call this the identity protection line, the point where your guaranteed income covers who you are, your home, your routine, and anything above that line becomes optional. Your $40,000 pension covers the needs column, the mortgage, the utilities, the basics. Social Security becomes the wants fund stacked on top of it. The Internal Revenue Service does not care which column the money sits in. It only cares about the total. And here's the trade nobody points out. The very Social Security fix that helps you also raises the price tag on the pension you already had. And that price tag does not arrive as a separate bill. It just quietly shrinks your refund every spring. Even with those 2 provisions gone, your $40,000 pension makes it very likely that up to 85% of your Social Security check will be taxed anyway. The Internal Revenue Service uses something called provisional income to decide this, and the formula has not moved since 1993. Take your $40,000 pension, add half of your Social Security benefit. If your Social Security check is $25,000 a year, that's $40,000 plus $12,500. For a provisional income of $52,500. For a married couple filing jointly, the moment that number crosses $44,000, up to 85% of your Social Security benefit becomes taxable. A $40,000 pension is usually enough to put you past that line on its own. That threshold has never been adjusted for inflation, not once, in more than 30 years. Every cost of living raise on your Social Security check pushes you further past a line that hasn't moved since the first Bush administration. So the new Social Security money is real, and it helps. But if you think the tax on that check is the hard part, wait until you see what happens once your combined income crosses into Medicare territory at the $60,000 tier. At $60,000, the pension itself is not the problem. The problem is what most advisors tell you to do with the money sitting next to it. Medicare premiums in 2026 are not based on your income this year. They are based on your tax return from 2 years earlier, in this case 2024. That 2-year gap is what I call the look-back, and it's where the real danger hides, because a decision you make today will not show up as a Medicare bill until 2 years after you've already spent the money. That 2-year gap exists because Medicare needs a finished tax return to calculate your premium, and the most recent one, available each January, is already 2 years old by the time the year starts. That's bureaucratic reality, not a loophole, but it means you are always planning this year's conversion against income. The government won't actually check for 2 more years. Here's where the standard advice falls apart. Most advisors will tell you to fill up your tax bracket with a Roth conversion, moving money out of a traditional 401k or IRA into a Roth account while you're sitting in a lower bracket. Reasonable advice on its own. But say your $60,000 pension and $30,000 Social Security check already put you at $90,000 in income. A conversion size to fill the next bracket the way advisors usually recommend, something in the range of $130,000, would push your total income for Medicare purposes to $220,000. For a married couple filing jointly in 2026, the Medicare surcharge zone, officially called IRMAA, the income-related monthly adjustment amount, begins at $218,000. Cross it by even $1, and your Part B premium jumps from $202.90 a month to $284.10 a month for each of you. On a $220,000 income, that conversion didn't just fill a bracket. It went about $2,000 past the line, and that $2,000 overage now costs the two of you close to $1,948 a year in higher Medicare premiums for 2 years straight before it resets. I used to tell people to convert as much as they could every year while they had the room. I was wrong, or at least half wrong. For a pension holder, filling the bracket without checking the Medicare threshold can turn a smart move into an expensive one. The fix isn't complicated once you see it. Subtract your pension and Social Security from $218,000, and what's left is your safe conversion zone. In this example, that's $128,000. Stop there, or stop a little short of it, and you get almost all the benefit of the conversion with none of the surcharge. Go $1 past it, and you're paying for that dollar for 2 straight years because of the look-back. This is the squeeze that catches a lot of comfortable retirees off guard. But at the $100,000 tier, the problem stops being a cliff you can step around. It becomes something closer to a mountain, and it has a name: RMD stacking. At $100,000, the pension finally covers everything: the mortgage, the travel, the grandkids. And yet a lot of people at this level tell me they still feel financially squeezed. Here's why. A $100,000 pension plus a $40,000 Social Security check is $140,000 of guaranteed taxable income before you've touched a single retirement account. Now add the required minimum distribution the Internal Revenue Service forces you to take once you turn 73. Say you have $1,500,000 sitting in a 401k or IRA. Your first required withdrawal, at roughly 3.6% of the balance, is about $54,000, whether you need the cash or not. Add that to your $140,000, and your total taxable income for that year is $194,000. That puts a married couple squarely in the 24% federal bracket, on top of whatever your state charges. And unlike a few years ago, there's no expiration date hanging over that bracket to plan around. The One Big Beautiful Bill Act, signed in 2025, made the current tax brackets permanent, so this isn't a temporary rate you're racing against. It's simply where you live now. Here's where it gets uncomfortable. If you don't spend that required withdrawal because you tell yourself you don't need it, the account keeps growing. Run that forward, and a $1,500,000 balance can become $2,500,000 by the time you're 85. At that size, your required withdrawal is no longer $54,000. It's closer to $150,000 a year, layered on top of a pension and Social Security that are also still coming in. That's RMD stacking, each guaranteed income source sitting on top of the next, pushing more of your own money into a higher bracket every single year, whether you touch it or not. Depending on where you live, your state may add another 4 to 6% on top of the federal bill, which is part of why two retirees with an identical pension can end up owing very different amounts based on nothing but their zip code. Ask yourself which version of that story sounds more like you, the one who keeps letting the account grow untouched, or the one who starts drawing it down deliberately, while the bracket is still one you can control. There's a way to soften that stack before it builds. The One Big Beautiful Bill Act also added an extra $6,000 deduction per person, over $12,000 for a married couple that some people use to offset a modest Roth conversion in the years before required withdrawals begin. It's a real tool, but it comes with a ceiling. That deduction starts phasing out above $150,000 in income for a married couple, and at this pension tier, you're already close to that number before you convert a single dollar. Use it early, in a year where your income is genuinely lower, not as an excuse to convert more than the deduction can actually cover. So why do people with 6 figures in guaranteed income still describe themselves as broke? That's not a math problem. That's a psychological one, and it deserves its own answer. You spent 30 years being the person who saves for a rainy day. Now your pension is the sun. It's reliably there every month, and you're still walking around holding the umbrella. It feels wrong to pull $20,000 out of savings for a trip or a cruise when the pension already covers the mortgage and the groceries. It feels like you're dipping into money that isn't yours to spend, even though you're the one who earned every dollar of it. Ask yourself honestly, when was the last time you spent money on something you wanted, not just something you needed, without feeling like you'd done something wrong? Here's a small shift that helps. Stop thinking of that traditional 401k or IRA balance as retirement money. Think of it as prepaid taxes. About 25% of every dollar sitting in that account already belongs to the Internal Revenue Service, whether you withdraw it this year or in 20 years. Spending some of it now, at a bracket you can see and plan around, isn't wasting it. It's collecting back what was always going to be yours, on terms you chose, instead of terms the government chose for you later, through a mandatory withdrawal. This shows up in small moments more than big ones. It's the tuition check for a grandchild, the insurance premium that crept up again, the home repair you keep putting off, because pulling from savings still feels like failure instead of function. None of those choices are reckless. They are exactly what the money was set aside for in the first place. I talked with a retired teacher last week who has a $90,000 pension. She was driving a car that was 15 years old, with the air conditioning broken, because she didn't want to touch the nest egg. That's not caution. It's a kind of prison she built for herself, with money that was supposed to buy her freedom. If you earned a pension like this, you already did the hard part. You don't need to keep proving it to yourself every time you consider spending $1 you're allowed to spend. Now picture a stretch of inflation, like the one that hit in the early 2020s, 3 years running at around 4% a year. If your pension has no cost of living adjustment, and a lot of them don't, that fixed $40,000 buys about $27,000 worth of goods and services 10 years from now. Meanwhile, Social Security actually keeps pace, with a 2.8% adjustment built in for 2026 alone. Someone who never coordinated the two, who just let the pension sit flat and assumed Social Security would fill the gap, loses ground every single year without noticing it happening. Now picture the version of this same household that used their gap years, the stretch between 62 and 73 before required withdrawals begin, to move some money into a Roth account. When that same inflation hits, they aren't forced to pull more from a taxable pension or a taxable withdrawal to keep up. They pull from the Roth account instead, tax-free, which means it doesn't add a single dollar to the income used to test their Medicare threshold. That's the entire point of using the gap years while you have them, not because Roth conversions are magic, but because tax-free withdrawals later give you a lever high inflation cannot take away. Play that forward at the grocery store or the pharmacy counter, where a fixed pension buys less every single year while the receipt total keeps climbing. Ask which household you'd rather be in before the next stretch of high inflation actually arrives, because by the time it does, it's too late to move the money. Same inflation, same 3 years. One household quietly loses purchasing power every year without realizing why. The other absorbs the hit without moving a single number closer to a Medicare cliff. So here's what to actually do with all of this. First, check whether your pension has a cost of living adjustment built in. If it doesn't, the savings sitting next to it needs to be invested for growth, not parked in something that barely earns interest, because that pension is quietly losing value every year on its own. Second, work out your own safe conversion zone. Take $218,000, the 2026 Medicare threshold for a married couple, and subtract your pension and Social Security. Whatever's left is roughly the room you have to convert or draw down before you risk the surcharge. Do this math every year, because your income picture changes as your Social Security payment grows. Third, if you're 65 or older, make sure you're actually claiming the extra deduction from the One Big Beautiful Bill Act, up to $6,000 per person, $12,000 for a couple, as long as your income stays under the phase-out. A lot of people qualify and simply never claim it. If you're navigating a pension and tax picture like this yourself, stick around and subscribe. We track these look-back traps so you don't walk into one blind. A pension is genuinely a gift. Very few people your children's age will ever have one. But it comes with a different playbook than the one built for a 401k alone, and the rules only work in your favor once you actually understand where the lines sit. You already did the hard part, building the income. The next part is just keeping more of it.